Hello, I'm back. Okay, so again, we're going to do the material variance, labor variance, and then I'm going to add factory overhead cost variance using the same sheet. Now, they have provided some of the information for us. So on this one, it shouldn't take nearly as long. So material variance. Again, we're going to look at our material quantity variance and our material price variance. And on this situation, they're telling us our standard costs with the quantity and costs, our actual costs with those quantity and costs, rate per direct labor hour based on 100% normal capacity of 3,200 of direct labor hours, and then they're giving us our variable requirements and how much we produced. Okay, so on this one, standard quantity, they've given this to us. So if we don't have to figure that out, and they provided it for us, we can. On the previous example, notice that they told us how much we produce, and it takes 20 minutes, so we had to go through that. Okay, so we had 5,000 for quantity. Standard cost is $50. So I take that 5,000 times the 50. So that gave us a standard quantity times standard price of 250,000. Actual quantity, that's the 4,950. Now remember, we're looking at usage, standard price of $50. Take those times each other. So then what I can do is I can take the difference, and that gives me a $2,400 favorable. Because we said we were going to do a standard quantity of 5,000 material, we only used 4,950. Purchasing our actual quantity, which was 4,950. Our standard price was $50. So we can take those times each other. Actual quantity, again, we're doing the material, so that was the 4,950, but our actual cost was $50.60. What's going to happen on this one? If you're saying, oh, I'm going to have an unfavorable, you are correct, because we use 4,950 units. We anticipated only paying $50, but we actually had to pay $50.60. That 60 cents got us. So subtract the difference. So we have unfavorable. I'll show you how I did that. I looked at this and I subtracted. Let's not do that. Let's this plus the 2,970. So our direct material cost variance, we were unfavorable. So then let's look at our labor. So labor, again, they provide us the information. We didn't have to go through a lot of the calculations. So they provide us that our standard hours is 3,000 hours. Our standard wages is $25. So we can multiply that out. Actual hours. We actually only had 2,945 hours. We still take it times our standard wage. Multiply those. So we have 73,625. Take the difference between these. So we are favorable for our time variance. For our labor rate, again, we actually had 2,945, but our actual cost for labor was $25.60. What's going to happen here? Okay, you said we're going to have unfavorable. You're probably right. So we take our actual hours times our standard wage. We take the difference of that between our actual hours and actual wages. So we were unfavorable when it came to the rate. So then we can add the favorable and the unfavorable. So for direct labor cost variance, we were 392 unfavorable. And that's when your productions guys will say, okay, so we had $25.60. Maybe we had a factory worker who earns a higher wage that had to fill in for somebody. Maybe somebody was on vacation. One of the people who are stepped down from them were on vacation, and we had somebody else come in temporarily. Well, that's going to make us unfavorable. Okay, what happens next month? Or did we have a price increase and we just never increased that? These are questions that will be asked. So the last part, which this part is kind of new, we have our factory overhead cost variance. So this one, when we're looking at factory overhead, we have to look at our variable factory overhead and we have to look at our fixed overhead. And I try to find something that's more in the book versus using my other little section up here. So actual variable factory overhead cost incurred. This is our actual variable, which was $16,680. Our budgeted variable factory overhead. This is when we produce 15,000 units. It takes 0.2 hours of direct labor, and our standard cost is $5.50. So what I'm going to do here, I'm going to take my 15,000 units produced times 0.20 hours, and then times $5.50, which was our variable standard cost. So we have 180 unfavorable. Okay. So then let's look at fixed. Normal capacity at 100%. It shows that rate per direct labor hour based on 100% normal capacity of 3,200 hours. Standard for amount produced. We only used 3,000 hours. That's what we anticipated. Okay, we can take the difference between that. That gives us, we're at 3,200 hours, we are at full capacity. We only used 3,000. So we kind of lost 200 hours that could have been used to create material. Our fixed cost is $4 per hour, so that gave us a unfavorable 800 hours. So then our total factory overhead cost variance, since both of these, let me go ahead and put this as a minus. That helps. And then we can add those. We are, for our total factory overhead cost variance, we are 980 unfavorable. And again, is unfavorable versus favorable good or bad? Not necessarily. Okay? We actually had 16,680. We budgeted 16,500. Okay? Our actual, more than our budgeted. So we need to determine, okay, what caused this issue? 16,680 that we budgeted for variable overhead, but here we thought, okay, 15,000 units, 0.20 hours per direct labor hour. This is a standard that we set for our variable overhead at $5.50. That's low. So we need to determine, why did we budget so low? Normal capacity, 3,200. We're only, based on our standard cost, we said 3,000. So our the production capacity that we're not using is 200 hours. That's revenue. Okay, that 200 hours, That's revenue that we haven't been able to use. And we set a standard for a fixed cost at $4. So that's unfavorable. Okay. So I hope this gives you an idea of how to do variances. Just understand, walk through the process, see what they're asking, and you should be okay. I'll talk to you later.